What is left to be said regarding the markets and impeachment, and how many corollaries to 98 are valid today?
Oh, I don't think any. I think the market clearly isn't paying attention to impeachment. It's looking at the economic data and powering ahead, I think, through the rest of the year.
Sean, you agree?
I agree. I think the market is definitely looking at, where there are opportunities as far as putting risk capital on. And it's a risk-on environment, so that'll continue for the next quarter or two.
Risk on because of what? Improving fundamentals? Do we believe the substance behind the China deal? Is this about the Fed balance sheet or something else?
I think it's the delta of change as far as things getting a little bit better. You've got clearly central banks have poured liquidity into the system. That's working its way through. So excess liquidity has to go somewhere. In the old days, it used to go into commodities and higher wages. Right now, it's going into financial assets. So you can see financial assets do better for the next couple of quarters.
All right, so Margie, if the market's largely shrugging off the drama in D.C. right now, what matters most? Is it Fed policy and the fact that easing maybe is starting to finally move out into the market and affect assets right now? Or is it the fact that we have these potential trade deals, whether it's with China, the phase one, or USMCA, or Brexit now moving forward, affecting the markets?
Yeah, I think the trade deals are pretty marginal to the outlook for the market. I think what's important, number one, is the Fed is stayed on the sidelines as they have all year. That's probably the biggest positive. They've been a destructive force in most years past. And I think looking ahead, we're likely to see the economic data start to accelerate in 2020. I think that's what the market realizes. That'd be a real shocker for people who are thinking that we'll have much slower growth and maybe even a mild recession next year. They aren't set up for that. I think that'll take the market even higher next year.
What's going to be behind that acceleration, Margie? If you don't think the market's trading off of trade, what's accelerating the economy next year?
Well, I think the Fed was too tight in 2018. They eased in 19, and it really takes a year or so before you see the effect of that. Globally, we've seen a lot of easing this year, so I think 2020, the surprise might be that we see a little pickup in global growth. Plus, our companies are maintaining those high profit margins. They're in great shape, so I think that earnings will continue to power ahead for the vast majority of the economy.
Although, Sean, we keep hearing from macro desks that everything Margie just said is absolutely true. But on a relative basis, the U.S. is just not the bargain around the world that it was at the beginning of 19, and that you're better off looking at EM, Eurozone, and Japan. What's wrong with that argument?
I think it's actually accurate. So in a risk-on environment, you're going to have to move away from the U.S. and look for other sources of opportunity. And emerging markets have trailed significantly over the last several years, so they should do better. Again, this is a couple quarter phenomenon, though, because at the end of the day, that excess liquidity, the tailwinds from the tax relief, those things are going to play themselves out by the second half of next year. And then it's going to be, what is the growth characteristic on a global basis? And I still think we have some problems there. And the world is really being driven by an equity philosophy at this point in time. But we all know credit drives the world. So if you have any hiccup or interruption at the massive amount of credit that's being put into the marketplace, then you could see markets have a tougher time.
Yeah, I was actually going to ask you about credit, Sean, because I know it's a focus for you. What are we seeing out there in general? Do you think things are priced a bit too rich right now?
Well, we've certainly seen the bottom end of the credit stack move backwards, so that's actually positive. You had a significant widening there at the very low end. Yep. But you still have that middle tier, kind of the triple B space, is incredibly tight on a historical basis. And there's significant amounts of triple B that are out there. So you still have issues. You're playing for the carry game at this point in time, which means you're hoping you get your money back plus a little bit of interest. And at lower, quality instruments, I always fear that trade over time.
So, Margie, if you believe that growth is going to modestly accelerate next year, where would you be positioned going into 2020?
Well, I think you should be overweighting equities because although I think the risk across the bond market is very low, including junk bonds, very low risk, the potential returns there are very small, maximum mid-single digit, whereas in equities, we have an earnings yield of close to 5%, a dividend yield of 1.8, that's equal to the 10-year Treasury. That says to me it doesn't take much for the equities continue to accelerate over any part of the fixed income market. So we like equities much more and are overweighted versus fixed income here.
Sean, when we talk about spreads, I noticed institutional investor bulls are near highs for the year. BAML fund manager survey cash near 7-year lows. When do we start talking about sentiment getting too hot?
I think we're there. The question is, how long does it last? Remember, tops can last for an extended period of time. So until you have that excess liquidity work its way through the system, you're going to have tight spreads and you're going to have people pouring money into the space. But we all know that there's significant amount of duration out there at these low interest rate environments, and credit spreads are really tight. I think people are getting too complacent and not doing enough credit work. So that comes back to haunt you at some point, but just not right now.